with gold, the reaction has been way too negative because, as you said, in an inflationary environment, the bet that you have to make if you're a seller of gold is that inflation stays in check and the Fed can manage their way through this environment without tanking the stock market.
So like I said in the beginning, gold has shown relative strength, and I stress relative because stocks, cryptocurrencies, they've all gotten hammered. Now, gold has done quite well over the last 4 weeks, except the last couple of days. What happened the last couple of days, Will?
Well, what happened was the Fed meeting that we had on Wednesday. And obviously the meeting notes, or the notes coming out of that meeting, suggesting a more hawkish tone in terms of raising interest rates and ending QE. That obviously sent the stock market into a bit of a minor panic. But also gold along with it. And we sold off pretty dramatically over the last couple of days on the back of it. So right now, what's happening with gold, what's happening with the market, I think it's all about the Fed at the moment.
Okay. Now, gold has shown, again, quite a strong performance relative to the other assets. Why do you think stocks and cryptocurrencies fell at the beginning of the year while gold remained relatively strong?
Yeah, I think again, inflation and expectations for Fed policy were probably the main reasons. I mean, I guess you could throw in the fact that stocks had performed incredibly well, went to an all-time high at the end of last year, so perhaps people were looking to take some profits. But I think leaving that aside, it was really more about these inflation numbers, highest numbers that we've had since this is the 70s, and people starting to worry about at what stage does that feed through to corporate earnings and therefore profits. I think that was really the driving force. In a high inflationary or an elevated inflationary environment, people expect some kind of policy response from the Fed, i.e. interest rates rises and tightening more broadly. And so I think the kind of combination of those two things is really what's happened. That's the story so far in terms of the stock market this year.
I guess another way to look at it is perhaps gold has just been behaving like a safe haven. When risk assets fall, gold has held up strong. Now, this is what I'm confused at, Will. The inflation story that has driven gold up the last couple of weeks. If you were to maintain that thesis that inflation is ticking up this year or is going to be persistent this year, yes, gold should perform well. But the Fed meeting, the statement that they issued this week, shouldn't change that inflation narrative. It's not like, well, they had a meeting, now all of a sudden inflation is going to go down, right? Gold should still see strength, but it hasn't.
You're right, David. Look, I think it's an opportunity. And we've seen this. I mean, my personal view is you're seeing this all over the place. And that's typically what happens in these kind of dislocation events. Microsoft come out with what I think most people would say would be fantastic results. Maybe a small check mark against the future cloud growth, stock sells off. I mean, what is going on there? Same with Tesla, came out with great results, stock sold off. And so I think with gold, the reaction has been way too negative because, as you said, in an inflationary environment, the bet that you have to make if you're a seller of gold is that inflation stays in check and the Fed can manage their way through this environment without tanking the stock market. And so I think that most people prior to the Wednesday meeting were actually loading up on gold as a hedge, in anticipation of the fact that, well, maybe actually this might not work out in the way as planned. And what if we do get a broader turn down? What if the tightening actually ends up happening too fast or too quick and we end up in a recessionary environment? So I think when I look at the gold sell-off last couple of days, I think it's an opportunity like I'm seeing in other areas of the market.
Okay, you brought up the R word. We will touch on that at some point later. But for now, I want to talk about some of the key drivers of gold and where you see these variables headed. So first, let's talk about inflation, narrow it down a bit more. Inflation, obviously, as you know, 7%, the highest level since the early 80s, Will. Is this going to be persistent, or can we see a retrace back down this year?
I think it's going to be persistent, David. And we're saying that, since the beginning. And that's not to say that inflation can't be managed. It's just to say that, this notion that inflation was transitory and was just a function of the kind of COVID or the pandemic economy reopening, I thought was a bit fanciful. And so now we're in a situation where it looks like it's more permanent, or in other words, it will stay higher or elevated for longer. And I think there are just some fundamental things like when you start raising wages, it's very difficult to take a salary increase back. And so there are things that just feel a lot more permanent, a lot more structural than just sort of short-term supply-driven increases. So yes, I do think that we could see some easing of the supply chain. We've seen some of that in the earnings where, whether it be Tesla or Apple, talking about the still supply chain challenges. However, they do seem to see those easing up somewhat. I think that will help, but we're still talking about ultimately an economy whereby we have too much money chasing too little goods and services.
Now, okay, inflation is going to be on gold's side this year, as you said. So the dollar then is another variable that gold responds to. Where do you see the dollar headed?
Well, I think the dollar, the immediate reaction is obviously that the dollar will strengthen on the back of any kind of tightening. But I think, again, like we've seen in the past, certainly the last tightening cycle, that there are limits to how much the Fed can raise rates, especially in an environment where we have now exponentially more debt than we did in the last tightening cycle, which obviously started in 2015, and that was obviously 7 years after the financial crisis. So I think that the ability to tighten or to raise rates in a way that perhaps some people think, and high as some people think, I think is perhaps a little bit of a stretch at the moment, because we didn't raise rates that much last time, and obviously we've got to a point where that was starting to have an impact on growth, starting to impact on the economy, and the Fed obviously backed off from that. So this time around, I think that we'll be most likely in a similar position.
Now, finally, real interest rates. Well, let's talk about nominal rates first. Nominal rates are the Fed is expected to raise rates. So where do you see the 10-year headed?
Well, I think that the expectation was for 4 rate hikes this year. Now people are saying that perhaps could be more, and again, not 25 basis points a hike. It could be as much as 50 basis points a hike. So I think in that environment, the 10-year certainly could end up in the year a little bit higher, obviously, than where we are today. But again, I'm not sure it's materially higher because of the restrictions or the constraints that I've just discussed.
Okay, so then real interest rates, which is the nominal rate minus inflation, do you see that headed lower then?
Well, real interest rates could rise on the back of rising nominal rates. I think that will most likely happen. However, again, it just depends on the rate of inflation. If inflation keeps going up, and certainly inflation keeps increasing faster, than the pace of nominal interest rate hikes, then we'll be in a situation where real interest rates get further into negative territory.
True. We have to remember that. That's an excellent point you brought up. Even though inflation might, I stress the word might, go even higher, the pace of nominal rates increases is also important. Recall that in the early 80s, we had a scenario where inflation was in the double digits, but the Fed had to raise their interest rates to double digits as well, which brought down gold. So just because we have a high inflationary environment, it may not necessarily be positive for gold. But let's put it all together now for the audience. What's your outlook for the gold market, given all these macro fundamentals that we talked about?
Well, I think right now, if you're negative on gold, I think the thesis really has to be that the economy, this is just a very short-term correction. The economy's in great shape. The Fed will be able to comfortably manage the inflation pressures. And in this environment, there's no need for a hedge. There's no need for ballast the portfolio. Now, I think that's a lot to take in. And I think a lot of people, or the majority of people, have to be in stocks because they can't really be in bonds in this zero interest rate environment, and certainly negative real interest rate environment. So people have a lot of risk in the portfolio as it is. And so I think the prudent thing for a lot of investors to do, we think about, well, what happens if any of those assumptions are not correct? What happens if this is just the start of a recession, a prolonged downturn, or a more severe downturn? What if inflation surprises to the upside again and cannot be kept in check, and there's a disorderly sort of market correction. And I think in that case, you need some gold in the portfolio. Now, gold ETF inflows have been very strong, and that tells me that there's obviously a group of investors out there that are looking to hedge, are looking to put some ballast in the portfolio, and maybe, again, are preparing for an environment where this doesn't turn out in the way, or it doesn't go as smoothly as perhaps a lot of people think. So I think in this case, you look at gold and the sell-off that we've seen in a couple of days and say, this is a potential buying opportunity for gold at this point, especially with a view to holding it as a hedge against some further downturn.
Is there a price outlook that you would be comfortable in sharing?
I don't really have a price outlook for gold. I mean, I thought that certainly before the last couple of days, I thought 1900 was in reach, even though we got still sort of $50 or so away from that. But again, I think if people start to get into gold and start to think that actually this is the start of something longer, again, there's not many hiding places. Where do you go if you're going out of equities, or if you're reducing risk more broadly? People say, well, you go into the bond market. Well, yeah, maybe the short end of the bond market, there's always going to take some allocation for the portfolio, but with inflation this high, I'm not sure that's the best place to go. So gold will definitely attract some of that capital, and I think from that perspective, gold could end up having a good year.